All right. Well, welcome, folks. Happy Thursday, as I mentioned, to this beautiful day that we have in the city. I don't know where you are, but it's pretty miserable here in Vancouver. That being said, like I said, I'm looking forward to chatting today for the next maybe half an hour, 35, 40 minutes or so. Just giving our take on what's happened in the last 30 days, give or take, since our last session, and what we should be thinking about between now and the end of the year. So with that, I'll jump into it. Maybe before I go through the agenda, just really quickly, as mentioned before, if you do have some questions, please enter it into the Q&A box that can be found at the bottom. There's a little icon. Click on it, type away. Like I said, I will try and answer questions throughout. I did happen to have a couple people send me some questions before the presentation as well, so I will address those near the end. So a couple things, keeping it really brief today. Three key topics. The timing is really good. Obviously we just had the shutdown, and yesterday markets are a little choppy today. So the timing for these comments today, like I said, works out pretty well. So the agenda quickly, the economy and markets. So I'll chat a little bit about what's occurred over the last 30 days. Talk a little bit about, is the winning streak at risk? What do we see on the horizon? What are some things that we're watching? And then I'll give you 4 ideas for just some year-end tax moves. For some of you, this will be a refresher. For others, this might be some new topics. So just quickly, with the economic shutdown, I always start with one of these. The U.S. Fed, the biggest thing with the shutdown, obviously, is economic data has been hard to come by. Nothing has been released on the labor market or the inflation market or the CPI. So the U.S. Fed is somewhat flying by the seat of their pants, I guess is a good terminology. Really, they don't really know what's been happening in the economy. They probably have some ideas, but generally speaking, their playbook moving forward is a little bit of guesswork. So we'll see what happens. I will comment about this in a second. So just quickly, I did this presentation, or I put this together over the last couple days. This slide here, obviously, the shutdown was still in the midst. It was lifted or ended late last night. Longest shutdown on record. Trump now owns the 2 longest shutdowns in history. 43 days this one lasted. And I think what's the key thing coming out of this, what we're seeing yesterday, the markets were pretty positive with the expectation of the vote passing last night, which it did. But now what happens, what we're seeing, and today I think is just kind of a snap reversal of yesterday. Now what has to happen is everything has to be digested in terms of what does the shutdown, what is the impact of the shutdown on a go-forward basis? How is it going to impact CPI? How is it going to impact GDP growth? And what we're hearing today, as things come out, moving forward, there's going to be some headwinds. There's no question in general, given the shutdown. I saw a statistic yesterday that the U.S. government borrowed over $600 billion over the period of the shutdown. So they increased, their debt levels by more than $500 billion while the shutdown was going on. So obviously, this is all going to filter down into the end users, which are the American people. Obviously, it could impact the economy, but there are some positives that are happening out there. So let's digest those. So really, the markets over the period of the shutdown. So I updated this as of yesterday's close. So since October 1st, notwithstanding what's happened today, markets, generally speaking, are flat or up about 2 to 4%, taking into today's account. So in large part, and I wrote about this in one of my commentaries a number of weeks ago, when this first started, I said, hey, generally speaking, when we actually look at shutdowns, what generally happens? And what we found, historically speaking, on average, markets generally move forward rather than contract during government shutdowns. The last government shutdown, that was also courtesy of Trump and his administration, we saw significant growth in the markets. So what's generally happened here over the last 6 weeks or so, markets have steadily increased in general. And there's some reasons behind that. Now, when we look from an economic standpoint, it's been busy as well in the last 30 days. So what's happened essentially is we've seen rate cuts out of the U.S. By the U.S. Fed, which was their second one We hadn't seen one in over a year. They've actually cut twice. And we anticipate them to continue to cut. We're not quite sure on the pace of their cuts moving forward. Obviously, a little less predictable, obviously coming out of the shutdown. On the Canadian side, the Bank of Canada is near the end of their rate cutting. Obviously, in Canada, we can see here, we've had significant cuts over the last, year to 12 to 18 months or so. So they're near the end of their actual rate cutting process. And then if you look at the inflation numbers, so the inflation numbers here are these lines, the blue and the green one. What's actually interesting here is both in the US and in Canada, US more so than Canada, we can actually see the inflation numbers are creeping up. And again, why that's problematic is as inflation creeps up, that's where it puts pressure on the central banks, whether they're going to continue to cut. So we believe the US will continue to cut, perhaps another time by the end of the year and then into next year as well. Canada, not so much. I don't think we'll get another rate cut. If we do, it'll be a bonus, but obviously we're down just above 2% now on their interest rate environment currently. So what are the expectations? I talked about this once before. Again, Bank of Canada, we can see here, the reason I'm saying we're not expecting too many more rate cuts for the balance of the year and into next year. They're near the end of the rate cutting cycle, whereas in the US, they just started to again. And I don't know, for those of you that joined me in my last session, one of the things I showed is I showed central banks around the world and what their cutting or their decreases on their interest rate look like. And pretty much all of them, with the exception of the US, are all near the mid to end cycles of their rate cutting. Again, the US, it's been very slow to cut given their strong labor and their high inflation. So again, US Fed has just started to cut within the last month or month and a half. So what has been good? I mean, what has been positive here in the last month and into this quarter? So in the last session, I talked about the Q2 earnings season, which was exceptional. In Q2, 79% of the S&P 500 companies that reported, they either beat estimates on revenue and 80% beat on earnings, which is significantly above their historical averages. Well, if you fast forward to the Q3 numbers and the reporting on the earnings season, it's about the same. It's actually better. So over 82%, almost 83% of the companies that had reported as of November 7th beat both on earnings and on revenue, again, well above their historical average. So again, corporate America, with rates coming down, obviously as we push through kind of this really growth wave that we're seeing in terms of AI and so on, which I'll talk about in 1 second, we're actually seeing a significant winning streak that we've seen by corporate America. And this is from a number of reasons. Again, I mentioned on interest rates reducing, but we're also seeing policies that are coming out of the States. The bill that was recently passed was very pro-corporate America. So again, this whole expansion that we've seen in the US, by and large part, hasn't been a significant surprise given how pro-business that administration is. What is a little surprising is how resilient it's been, given the fact that it's been a very choppy year starting, in February, March, when all the trade-related news and policies came out. There's been a lot of headwinds that, generally speaking, the economy is digested and marched forward. So on the transition, is the fun over? What's the investor sentiment? And I think this is what's really critical. Despite the wins in the markets over the last, 11 months, as we enter here in November and we're in the final stretch of the year, I think what's really interesting is that despite things being pretty well or pretty good this year, I think investor sentiment is getting a little bit tired. It's kind of waning a little bit. And it's even through some of the comments that we're having with some of our families. Folks are saying, hey, I know this year's been decent, but, what's on the horizon? I'm just feeling a little bit of angst. So let's unpack that a little bit, and then I'll give you our opinion as we move forward into the balance of the year. So what's really interesting, when Trump came out early in the year and he talked about all the trade-related policies, obviously this is a fear and greed index that's, used quite frequently within the investment industry that's put together on a number of different metrics. Well, we can see in general, the general sentiment of investors went from somewhat neutral to negative quite quickly, through the trade announcements. And then when Trump came out and delayed tariffs, if you recall, he said, hey, we're going to push everything out for 90 days. That's really when the US engine really started to hum. And we saw investor sentiment improve very quickly, and was in the period where, again, at certain periods, they went into greed, extreme greed, and so on. Well, this is the period here that we've been living in over the last, 2 quarters. As we've entered in the final quarter, then this is where the shutdown here, we really saw that sentiment in general has shifted overall. And I think just as investors, it's been a long year, to be honest. Like I said, we've really gone through some different roller coasters in terms of the announcements and the policies. I think we're all, looking forward. Hopefully things are going to improve, maybe have a little bit less rhetoric and get a little more consistent and predictable type announcements that are going to be coming out of the US. So when we look at the volatility index, we can see here again, if we go back to this again, this is when the announcements were originally made. You can see the volatility index spiked significantly March, April. But again, calm down. We went through the summer and then early fall months. Not a lot happening in the markets. Very consistent, predictable type growth that we've seen. But again, since the shutdown started, again at the beginning of October, we can see volatility in general has actually picked up a little bit. So in the last, I would say, month to 6 weeks, I think, again, the comments that we're getting on a more frequent basis, the media sources, I think, again, has been a little bit more negative. But again, I think we have to digest those, make sure that we're actually sifting through the information and making some accurate conclusions on what's being reported. So there's just a couple potential disruptors to that. Again, the biggest economy in the world and the US. Obviously, we have already talked about it, but tariff head fakes. So really difficult to actually get some consistent, predictable direction within the economy and the markets. One day we have tariffs, the next day they're delayed, and so on. And this is where that term, the taco trade, has come from, right? Trump always chickens out because he says today, hey, we're going to put on these excessive tariffs on China or Canada here locally. And then shortly thereafter, he pushes them off for extended periods of time and pushes them off to the future. So it's really difficult to get into a predictable type period where we can start to look at what we feel is going to happen in the economy and the markets. The second one is two Americas, the emergence of the K-shaped economy. What this means is, the rich are getting richer and the poor are getting poorer. So we're getting this divergence between kind of different asset classes. So yes, there is money to be made from the markets, from the economy, and so on, but not everybody is participating on it. Generally speaking, people that have money invested in the markets and so on are benefiting from it. Those that aren't, the end user, think about when you're going and buying groceries. I went and bought groceries over the last few days. There are less products in the bag when you walk out than what there was, 5-6 months ago or a year ago. So again, those folks that are on the lower end of the economy, it's hitting their wallet, the end user, which is tough. Again, number 3, America needs workers. Again, we're seeing this shift in kind of new labor market as we're going through this robotics and automation. So again, we're seeing a shift a little bit in the labor markets. Again, difficult to actually predict what's going to happen because, again, they haven't released any new data in the last month and a half. Big government forever, the cost of a constant floor under the economy. What I mean by this is, in a lot of cases, the government in the US anyways keeps on propping up the economy based on different monetary policy. So a really good one that has been bantered around a lot by Trump is he wants low interest rates. He's been grinding the US Fed for a number of months. He wants to get the cost of borrowing down much lower. So it's really difficult to gauge the health of the economy today and in the future when you're getting intervention from the government. Okay. So again, if this gets to be a little bit more predictable, it'll be a little bit easier to see what's kind of ahead on the horizon. And then the last one, obviously, housing markets. Housing markets we've seen here both domestically in Canada and the US. They've actually stalled a little bit. Housing markets in general is a great form of wealth in the US. And again, without that, without the turnover, without the growth, again, it really is a drawdown on their economy. Okay. Another one that we look at, so just not only those, again, I'm sounding negative, but again, these aren't negative, this isn't negative information, but things that we need to be aware of, okay? So another one that we can look at is just the US manufacturing numbers. So generally when it's under 50, it actually is a sign that the economy is sluggish. And so we look at 2025, early 2025, I said this earlier, Trump inherited a pretty good economy at the time. Earnings season was good. Markets were good. We were seeing growth, GDP and so on. And through a lot of, unfortunately, the administrative policies that have come out, it's actually put some brakes on just the economic growth in general. And we're starting to see some of the tariffs, obviously in the inflation numbers. We're starting to see them in the inventory numbers. What happened essentially when tariffs came on, a lot of companies, they quote unquote, front run the actual tariffs. So what they did is they loaded up on inventory early. So they were sitting on significant amounts so they could actually sell through it. What we're seeing now is we're seeing companies that have worked through that inventory, and now they're having to buy and manage these tariff related costs. So that brings me to a question that I'm getting a lot. So I thought I would spend a few slides on this. A lot of folks are saying, hey, I recognize that we're making money because of the whole AI shift in what's going on. Okay, which is a good thing. Think companies like, Meta or Facebook, Google, Amazon, Microsoft, Nvidia, and so on. All of these companies are benefiting from this new growth engine of AI. So naturally speaking, a lot of people remember the tech wreck in 2000, 2001, 2002. And so people are saying, hey, is it the same? Are we going to see a 2000, 2001, 2002 bubble all over again? And could we've had some excessive growth. Could we see a contraction? I mean, we see contractions inevitably in any market, regardless of what the underlying information is. But when we actually compare what's happening today in terms of what happened, over 20 years ago, when we actually look at the valuations and growth of the NASDAQ today versus where the tech bubble was, again, looking back 2 decades ago, they're very different. Okay. The tech wreck that we had, way back when, was built a lot on anticipation. It was built a lot on no substance, essentially. So some of the key differences between what we're seeing today and the tech kind of wreck a number of years ago, number one, earnings and growth. So unlike the dot-com bubble, the current AI boom that we're seeing of economic growth is fueled by companies showing true earnings. I don't know if anybody on this call remembers, or if you're a sports person or a football person or what have you, but if you go back to like 2001, maybe the Super Bowl, one of the big hypes of the Super Bowl is the commercials. And if you go back and look at the commercials back then when we were going through this, tech boom, a lot of the companies that were actually doing commercials were all tech companies. And a lot of these companies are not even around today. If they had an idea and they had a way to potentially make money, people invested in them. You just needed an office back then. Okay. Today, the boom that we're seeing are with some of the biggest companies in the world. Like I said, the top 7 to 8 companies in the world are actually providing this growth engine. Okay. So that's number one. Number two, public frenzy. So again, while there is excitement around AI, the current period lacks the extreme public, market excess of the dot-com area. So that's what I was just saying. Like, again, you had a good idea back 20 years ago, you got funding. Whereas today there needs to be more substance. And don't get me wrong, there will still be companies that will have a good idea and will raise money. But for a lot of the folks on this call, those aren't the ones that we are involved with. The ones that we're involved with are the large cap companies that, believe it or not, are actually be considered value companies. The Microsoft of the world, the Apple of the world. These companies today are actually part of value indexes because they're so large, they pay dividends and so on and so forth. Okay. Number three, the investment landscape. So again, a lot of the AI investment is happening through private venture capital rather than IPOs. So if you remember in the tech boom way back when, you would see a lot of companies with an idea come out. There'd be an IPO, which is an initial public offering. A private company would go public. And then investors like you and I would think it was such a great idea, you might buy it on the stock market, or they might be part of a fund or an ETF or what have you. So again, there was a lot of companies that come to market with not a lot of substance. And then the last one, although some current valuations appear high, they're nowhere reaching the levels that we saw in 2000. Okay. So here's a great graph. You look at profitability, way back when in 2000, 2001, 2002, we see profitability of companies is way stronger today than it was 20 years ago. Okay. So again, you can really see the peak here in 2001, 2002 of unprofitable companies in the tech sector. Okay. Balance sheets. Here's another good one. So balance sheets. I talked about Apple. I talked about Amazon and so on. They are hoarding cash. They have cash on their balance sheets with significant amounts. So when we actually look at some of the healthiest balance sheets in the market, the technology sector in general has the best. Okay. And it makes sense, right? Because again, these companies have built hordes of cash over time. Yes, they do take on debt. Most companies will take on debt when they're growing. They reinvest it at lower rates. So as an example, companies will borrow from a financial institution, a bank, whoever, because they believe that their capital that they're borrowing on, they pay a lower rate than what their growth rate is. So there's some arbitrage on it. So it's a good use of their money, okay? But even when you factor in borrowing in general, and you look at the tech sector, some of the healthiest out there, okay? And then the last piece of the puzzle, again, when we look at tech valuations, and I heard somebody talk about it today, when you look at NVIDIA's forward-looking price to earnings ratio, it is high, but when you actually look at it and compare it to some of the large cap consumer companies that are out there, it's actually on a very similar level based on future growth. So when we actually look at the relative technology to the world, the forward PE that this chart is showing, again, you go back to 2000, 2001, 2002, it's significantly different in terms of the PE, the forward-looking PE. So I'm not saying there's not some risk in this sector, but fundamentally, we're much stronger today than when you go back to what it was in the early 2000s. So this goes back to when we're investing, I think this is really important that we go back and we look at, what should we expect in these types of markets? Guys, volatility is inevitable, okay? Corrections, pullbacks, they're going to happen. And given the fact that we've had 6 to 7 pretty good months since tariffs were delayed in April, it would be no surprise to see us go through a period of time where we see some pullbacks, okay? Now, that being said, for us, we go back and we say, hey, how do we manage our clients' portfolios? How do we manage their money, okay? We want to make sure that we participate on the upside. That's the whole goal. We want to make money and we want to beat tax and inflation over the long run. But because we recognize volatility is inevitable, we want to make sure that we're positioning a portfolio that when we do go through contractions, we're actually following less than the markets. And if we go back as just recently in February, when we actually saw markets fall 10 to 20% in a short period of time because of US trade policies, a lot of you that are on this call, a lot of our clients fell single digits, low single digits, mid single digits. So the portfolio performed is exactly how we anticipated in these periods. So when we look at this chart here, again, all these bars on the top here, okay, here's 0%. All these bars, you go back over the last 45 years, these are the annual rate of returns of the S&P 500, the calendar rate of return on the S&P 500 that goes up to 2004. But what's interesting is if you see all these dark squares here, this was the intra-year decline that the market experienced between January and December. So here's a great example. So I don't know, let's pick one here. In 2009, the market was up 10% total, but at one point it was down 22%, which makes sense because if you remember, we came out of 2008, the first 3 months or so were somewhat difficult. And then the bull market started, near the mid to end of March of that year. Okay. Same with, again, if we look at I don't know, what is this, 2013, 2012, the S&P 500 was up 14%, but during the year it was down 6 at some point. So again, these peaks and valleys are inevitable. They're going to happen every year. Okay. So we can't avoid them. We just have to recognize that when they occur, that we've done our job looking backwards in terms of how we position the portfolio, based it on the risk tolerance time horizon of everybody. And again, we navigate, some of this drop that we see. Okay. And then my last slide before we jump into some of these tax ideas, again, there's always reasons to sell, folks. Okay. This goes back, the last 16, 17 years. These are all the events that have happened, between 2009 and roughly 2025. Okay. There's Brexit. There's the financial crisis. There's COVID. COVID was a substantial move in the markets that was not fundamentally driven. But that being said, we go through all of these periods of time, and markets continue to push forward over the long run. So I don't know what the short term holds, but most people have a mid to long term time horizon. And when I say long term, I don't mean 20, 30, 40 years from now. I generally mean a market cycle, maybe 8 to 10 to 12 years is what most people have. So when you look at that over the long run, over that period, we generally will see positive results despite what happens. And I actually think we're in this bull market right now. 2022 was the last pullback, which was a bear market, first fundamental bear market since 08, 09, notwithstanding 2020 COVID. So I actually think we're in the midst here of this bull market, which generally lasts between 5 to 7 years. So can we see some drop between now and the end of the year? Absolutely. But there are reasons why, now that the shutdown is behind us, if the US Fed continues to cut, corporate earnings continue to be strong for the balance of reporting season. Again, I think we'll work through it between now and the end of the year. Okay. If you guys have questions about the portfolio, questions about the markets, please reach out. Please reach out by email, give us a call or what have you. Happy to have that conversation. All right, guys, just switching gears here to some year-end tax considerations. Okay, some of these things that we do internally for you on your behalf. So number one, there's tax loss harvesting. So what this is again, for those of you that aren't familiar with it, if you happen to have an investment in a non-registered account, I don't know, let's say you invested, let's just pick Royal Bank. Royal Bank is an easy one. Let's say you bought Royal Bank as an example. You bought it for $100,000 and it's now worth $90,000 for whatever reason. You're down $10,000 on paper. Well, if you essentially sell Royal Bank at $90,000 and you just simply move it to maybe another bank, TD Bank, Bank of Montreal, CIBC, or whatever, making a lateral move, that triggers a $10,000 paper loss. Okay. Now that paper loss is what's called the realized capital loss. That can now be used against other capital gains you've had throughout the year, or it can be carried forward forever, which means if you have a capital gain next year, 3 years from now, 5 years from now, so long as you have record of this capital loss, which is generally recorded on your tax returns, you can actually utilize that to reduce future taxes. Okay. We call it tax loss harvesting. We will do a review of the portfolios, any significant declines that we have in the portfolio. We'll generally make that trade on your behalf. We're just starting to do the reviews now. So we'll be doing that probably over the next 2 to 3 weeks. Okay. There's not going to be a lot, I don't think, in the accounts, to be honest. I mean, obviously the last couple of years have been pretty good, but where it does make sense, we will actually process those on behalf of the clients. Okay. Number one. Number two, a registered plan withdrawal. So a registered plan withdrawal would be from an RSP, a RIF, a LIF. If a LIF is if you qualify, if you can take it out. So what we mean by that is if for whatever reason you have low income this year, or maybe between you and your partner, you have low income, in some cases, it might make sense to do a withdrawal in order to increase your income. Now, I know that sounds a little counterintuitive, but I'll give you a real life example. So we have a client that is going to be actually drawing down a pension next year. Okay, he worked with the city. He's going to be withdrawing on a pension. That pension is going to be fairly significant. So this year, they do not have the pension yet. They're drawing it in 1 year. So we've looked and we reviewed their portfolio and their income this year, and we're actually going to make a lump sum withdrawal from their registered plan in order to increase the income this year. because we know next year, any withdrawal, next year or any year thereafter, any withdrawal is going to be taxed above and beyond the income they're going to get from their pension. So this is an opportunity that we have a couple years, or 1 year in this case, to actually do some tax planning by actually creating extra income, simply because we know what their future income is going to look like. Okay. Now, in your case, if you don't have a pension next year, the year after, or so on, but you have very little pension, here's another example. In BC specifically, our basic exemption that we have is roughly $15,000 to $16,000. Okay. What that means is that we as people that live in BC can make roughly $15,000 to $16,000 a year, and you may pay a little bit of tax when you earn it, but when you file, it works out to be zero tax on that amount. So we can make up to that amount, pay no tax. Okay. So again, if you have very little tax, then you might be able to do a registered plan withdrawal in the neighborhood of $15,000 to $16,000 and have very little tax paid on that withdrawal. Okay. So yeah, registered plan withdrawal. Does it make sense? We do have a number of clients. It does make sense. We've actually made some notes over the next few weeks. We'll be executing those. Okay. One other comment on the registered plan withdrawals. We generally save these to the end of the year for two reasons. One, our clients get continued deferred withdrawals on the growth, deferred gains on the growth while it's invested throughout the year. And the other reason we do it at the end of the year is if for whatever reason they have some unexpected income throughout the year, we don't want to do it early in the year, because then if we withdraw at the end of the or beginning of the year, then they have income. Now we might put them in too high of a tax bracket. So all of these withdrawals generally are done near the end of the year for tax planning purposes. Okay. At number 3, there's two things. One, trigger or defer capital gains. Again, these could be 3A and 3B. So what I mean by trigger, again, it depends. If you have capital losses, you can offset it. Number 1, you might want to trigger it again because of your income situation. So perhaps you might be wanting to actually trigger some gains for that given year. The other one is the opposite, where you're deferring capital gains. So you might have somebody that says, hey, I want to gift some money to a child, as an example. I want to give them $200,000 to help with a down payment on a home. Well, because we're near the end of the year, what we can do is say, okay, well, we can trigger some of the gains before the end of the year that'll happen in the tax year of 2025. And then maybe we defer, the second tranche that they might need in the new year. So now you're spreading out capital gains between 2025 and 2026. Okay. That might be the same too as if you have to make an RSP withdrawal for whatever reason. Instead of doing it all in one shot this year, maybe you do a little bit this year and some early in the new year. So you can take advantage of where we are in the year to actually split taxable income between this year and next year. Okay. And then the last one, number 4, and we get these happening here as we get closer to the end of the year, is charitable donations. I talked about it in the last session. I will actually give another quick example about why these make sense if people are trying to reduce tax and also maybe give to a charity of choice. So a couple of things. 1, you reduce taxes. 2, you get a receipt. And then again, the third one is to make an impact. Okay. So let's just walk through how this works. So 1, to actually make a donation, what you could do is just, you have a security in your non-registered account and you just simply sell it. You sell it, and whatever cash is left over from that sale of that security, you just simply give it to the charity. Okay. Now, yes, this is one option, but it's not very tax efficient. So what I mean, if we walk through scenario A, okay, let's say the current value of the shares is 25,000. The original cost was 5,000. So there's what's called a capital gain of $20,000. In Canada, currently under the income tax rules, half of that gain, or $10,000, is the taxable amount. Now, in this example, they're using a 46% tax bracket. So of the $10,000 gain, $4,600 is what you have to pay to the government. So you sell 25,000, you donate 25,000, you get a tax credit of roughly $10,000, but you have to still pay the tax. Okay. When you file the next year, you're going to pay the $4,600. So your effective tax credit is reduced by the tax you pay. Okay. So the net cost to donate 25,000 is 19,600. That's what you're actually giving them. Now, if we just think about this a little bit differently, Okay. You still are going to use $25,000, but instead of selling and contributing the proceeds, you can actually donate those shares in kind, meaning you give them the shares. Okay. So again, same thing. Current value of shares, 25,000. Original cost, 5,000. Capital gain is still the same, 20,000. But because you're not selling it, there's no personal taxation. You essentially donate the full amount of the shares, which is 25,000, and you get the full tax credit of $10,000. Okay. And now the net cost to do that donation or that gift is only $15,000. So essentially what you're effectively doing is you're making a bigger impact and you're reducing more taxes by simply donating shares that have appreciated versus selling and donating the cash. Okay. So again, it doesn't cost you any more to do this. It actually saves you money by actually just being more efficient with how you process these types of tax savings. Okay. So again, if you have questions on these, if you are curious on how to maybe minimize some tax between now and the end of the year or future years or what have you, flip us an email or give us a call. We will help walk you through if this is something that interests you. Okay. All right, folks. So that's kind of the wrap. So I've actually given you some context. I've given you some context last 30 days. I've given you some context in terms of what we see, looking forward between now and the end of the year and some of the headwinds. Again, we remain cautiously optimistic. That's our biggest takeaway. If we do go through some rough periods, we believe the portfolios are really well positioned. This is the way we manage cash on behalf of our clients, so money on behalf of our clients. And then I've given you some tax planning tips. These are just 4. There's probably more. If we have more time, I can go through more. But this is, some of the more common ones that we will be doing in-house for our clients. Okay, so I'm just going to open it for questions. I have actually had a few that have actually come in. I've actually had 2 that have come in. So the first one is somebody had made a note. They reached out to me. They said, hey, I saw in the Financial Post recently that the next cut or the next decision by the U.S. or Bank of Canada, sorry, not U.S., Bank of Canada might be a rate increase. Okay. It kind of caught me off guard. And I think this is the important piece of digging through what's being reported so we understand what decisions or ideas we should be thinking about. So this article from the Financial Post, which came out within the last 48 hours, talked about Bank of Canada's next rate decision being an increase. Okay. So I thought, well, that's pretty interesting. So I dug through it a little bit. And what was interesting, what it said is, in this article, it said, hey, we don't anticipate any rate adjustments for 2 years. We believe the next decision by the Bank of Canada will occur in 2027, guys, 2 years from now. And that rate decision will likely be an increase versus a decrease. Now, I have a couple of comments on this. Number one, trying to think of what the Bank of Canada is going to do over a 24-month period, I believe is a futile exercise. But we recognize, we've learned over time, the media is looking for clicks on their websites in order to sell advertising or in order to get viewership. So you're more likely to click on a headline that says, hey, Bank of Canada's next decision will be a rate increase than if they would have said, hey, the Bank of Canada is going to sit idle for 2 years before they make a decision to increase interest rates. So it's really important to recognize the media. What we see in the media sometimes is a half truth. And, especially, again, not to get into politics, but we're seeing this with the narrative about it in the US with a lot of different policies. So again, really important that we look through it. Again, we recognize negative news, negative media sells at a much rapid rate than actually positive news. Okay, they've done studies on it. So again, if you see something, have a read on it, dig through it. If you still have questions, let me know. Okay. Another one here is that somebody said is, okay, well, where do we go from here? Okay, I've heard what you're saying. Again, I don't think we make too much in the way of any knee-jerk reactions. I think in Canada, I think you really need to be, I think investors, which we've done for you, but I think investors in general have to reassess, where they're maybe generating some cash flow. The easy interest rate yields are gone. Bank of Canada, because they've been aggressively cutting short-term interest rates now are probably sub 3%. On cashable GICs, probably even lower than that. Meanwhile, like I said, if you're looking at after-tax income, return of capital, dividends, capital gains are preferred. And I think there's some really attractive names out there on the equity side, whether in the US or in Canada, that you could probably generate a reasonably a 4 to 5% dividend yield that would replace some cash flow that we've seen actually reduce. Okay. Last piece on the cash flow is obviously interest income is fully taxable. So we will likely get some feedback next year when some of you file that have GICs. You might say, hey, didn't realize I was going to owe so much tax. I'm not sure what's happened. It's likely because obviously interest yields were higher, and often you don't account for that. All right. I have a question here. If we have excess cash, should we hold or invest right now? I mean, I would say invest, and I'm not saying that because of the work that we do. Again, you can invest and still be, if you're worried about the markets, you can still invest more conservatively. I think holding it in again, it depends. If it's in a corporate account versus a personal account, corporate account is even worse because in corporate accounts, passive income is taxed at 50%. So if you can turn that in, I talked about return of capital in my last session, last time we connected. Return of capital, you don't actually pay tax in the year that return of capital, but rather in the future. So even if you take a more conservative approach and you say, hey, I might not want to invest in equities right now, we can still get you on things that actually will just be more efficient from a tax point of view and yield. I believe, with some of these, and again, I look over to the left at my TV, we're getting some pullback here. I think it's always great to buy on these dips because what we've actually seen, even if we go through these periods of contraction, again, I think we have, brighter days ahead. So again, if your time horizon is a little bit longer than short term, then yeah, I think investing makes a lot of sense for sure. So, okay, I got a question here. With the donation of shares, I have ended up with a tax slip. How do I handle the tax slip as there should be no tax paid? So again, I can't specifically comment on it because I don't really know the steps that you took to donate those shares. But this would probably be a good question for your accountant. Again, if you had a tax slip, I don't know if you're talking about the tax credit or the charity tax slip, but again, it should all be filed within your tax return. And again, good question for the accountant. All right. Okay, folks, I don't know if there's any other questions. I will pause for 15 seconds in case anybody else has a question. And if there are no other questions, I will let you get back to the beautiful day we have here in Vancouver. Make sure to bundle up. Hopefully we'll get some better weather here in the near future. But for the time being, we did have some spectacular days over the weekend and on Tuesday. So I'm sure, just as I mentioned about the markets, brighter days will be ahead. I'm confident with that. And then one last little thing here, guys. So I still see we have a lot of folks that are on here. For those of you that received our movie night or movie day that we're hosting with the Polar Express, if you are interested, we have had quite a few people that have already expressed it. Please go ahead and RSVP so we can add you to the guest list. Okay. So once again, December 6th, I think it is, we're going to be doing the movie night. And we've had, actually, it's been great. We have grandparents, parents, and the grandkids that are attending. So if you have questions on that, again, send us an email, what have you. All right, guys. Well, listen, enjoy the rest of your Thursday. If you do have questions, let me know. Other than that, we will likely see you guys in December. All the best, and we'll chat soon. Take care, guys. Bye now.